Most people think financial crises begin in the stock market, but history suggests otherwise. Here's a simple and intuitive thought process that most people fall prey to. The assumption is that capital markets soften and drop, and then, in the fullness of time, the economy follows. That's because it's generally accepted that the stock market is a leading indicator for the economy. That's the sequencing that occurred in 1929 at the onset of the Great Depression, and many people use that as a template for what to expect in the future. However, people may be looking at the wrong things. Across more than 2 centuries of economic history, major crises have frequently been preceded by periods of intense land and real estate speculation. Long before banks fail or stock markets collapse, property markets often display the first signs that the credit cycle is reaching its limits. That's certainly what happened in the global financial crisis of 2007 to 2009. Consider a few additional historical examples from the US. There, land speculation surged in the late 1810s as easy credit flowed into frontier development. Prices peaked in 1818, followed by a panic in 1819. That was the first major crisis for finances in the American history. A similar pattern emerged in the 1830s. Rapid land speculation peaked around 1836, and the following year, the Panic of 1837 triggered widespread banking failures and a severe economic contraction. Then, during the expansion of railroads in the 19th century, land speculation intensified once again. The boom culminated in the 1872-73 period, shortly before the Panic of 1873 launched a global depression that lasted for much of that decade. Now, that's all ancient history, right? The pattern continued into the 20th century. Now, let's look at Japan. Many people watching this may recall that Japan's property market peaked in 1989, ushering a prolonged period of economic stagnation known as the Lost Decades. The Japanese stock market hit an all-time high at the end of 1989 and only reached new highs a couple of years ago. Over a third of a century was lost in the interim. More recently, the U.S. housing market peaked in 2006 and 2007, and just 2 years before the global financial crisis peaked in 2008 and 2009. So why does this keep happening? Real estate sits at the center of the modern credit system. A large share of bank lending is secured by property, which means rising land and housing prices often enable further credit expansion. As borrowing increases, asset prices rise further, reinforcing the cycle. But when property prices stop rising, that dynamic begins to reverse. Lending slows, leverage becomes more difficult to sustain, and stress spreads through the entire financial system. Lots of people in Canada today bought homes and took on mortgages 5 years ago when mortgage rates were unsustainably low. Now, the economy is weakening just as those mortgages are coming up for renewal at much higher rates. The point in all this is that real estate markets often serve as early indicators of broader financial instability, and people who ignore history are often destined to repeat the lessons they ought to be familiar with. From a longer-term perspective, these credit-based episodes often occur near the end of major economic expansions, periods when optimism is high, leverage has accumulated, and speculation becomes widespread. I worry that optimism has clouded the judgment of many people these days. Eventually, the financial structure built on expanding credit reaches a point where it can no longer continue. Most people accept that the last real bear market for stocks ended in March of 2009. We've experienced a very long winning streak, and I fear that people may have become complacent. Overconfidence and recency bias may be causing people to be less careful than they otherwise might be. Economist Joseph Schumpeter described the resulting adjustment when the economy reacts to overextended credit as creative destruction, a necessary process through which excess debt is cleared and the foundations for the next phase of economic growth are established. The lesson here is not that real estate causes crises. Rather, it is that property markets often reveal when the underlying credit cycle has become overstretched. I believe that we may be at one such point now, and understanding these patterns is important for investors, policymakers, and anyone trying to make sense of the broader economic environment. My concern is that as we head into the spring of 2026, the credit cycle is once again showing us that the real estate market is stretched. Canadian household debt is higher than it has ever been, even though the economy has been growing, albeit slowly, for many years. I remember back in 2007 when I read an article in the Globe and Mail warning that the situation with subprime mortgages was about to get ugly. I dismissed it because my clients were invested in global stocks. I didn't see how a downturn in American real estate could have an impact. I now understand that the real estate market is often the canary in the coal mine, and that a softening in real estate is often an early warning of more perilous times ahead. I absolutely think history is about to repeat itself.